Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamayev. How are you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor. Call your broker. That's what they're there for, to give you advice, provide you with guidance. There's
Excellent.
the disclaimer. And let me share my screen before we get started. Will, you want to tell everybody about the
Yep, we have a webinar today with Interactive Brokers at 2 p.m. I will put the link in the chat. I think it's calendar spreads, D, today, if I'm not mistaken.
Yep. So we'll be talking about calendar spreads. I'm going to give some examples, and we'll just go through the setup, the different risks in a calendar spread, how to evaluate a calendar spread. We're going to generate a payout diagram or an options profit calculator showing how we could estimate what the calendar spread could potentially return. So we're going to do that at 2 o'clock today with Interactive Brokers. Interactive Brokers is hosting it, so you do have to register with them. Well, if you could put out a link there.
Links been put out in the chat.
Okay, yeah, so it will not be on the YouTube as we usually do it, because it's within Interactive Brokers webinar community. So that's 2 p.m. Eastern today.
Perfect.
For now, what we'll do this morning is, if anybody has a question about Market Chameleon tools, data analytics, strategies, you could put the question in on the live chat on YouTube. Will's watching it, he'll read it back to me. If you want to come on a show and ask your question live, we also put out a link to Zoom. Click on that link, takes you over to Zoom. Once you get into Zoom, there's a button, raise your hand. Click on that button. You don't have to turn on your video camera, but once we let you in, you'll be able to ask your question live. Everybody will be hearing.
Yeah, and to rewatch that webinar, Rob was asking, he's going to be traveling today and can't watch the webinar. To rewatch it, you just have to register, and I think IBKR will then alert you to the replay, the availability to replay it, and it sits, all the webinars we've ever done sits in the IBKR webinar library, so you can search them all, so you'll be able to find it there.
Yes, exactly. And I think that, do we mail out like a replay afterwards?
We do not control any of the video.
Okay, right, so we don't do that, right? But you'll be able to find it on the on the Interactive Brokers web.
Correct.
All right. While we're waiting for questions to queue up, what we'll do is take a look at the pre-market report, then I'll move on, maybe set up a different option strategy. And if I sneeze, I got to apologize right now, because I feel like I have one coming on and then it goes away. And so it's,
well, I'm hoping you sneeze. That'd be great. That would make great footage.
I got one of those, really loud sneezes that I've developed all of a sudden, where even my wife gets all upset at me. She thinks I do it on purpose, and she's like, the whole place shakes when I sneeze.
No, I've got the same type of sneezes.
Really? Yeah, I don't know what happened. Yeah, went from regular sneezes, now they're like a thunderstorm. But I feel like it's going away. But
I tell my kids that I sneeze like that because of walking in the dust after September 11th. I've always had it.
I think you started, and then I followed you with those really loud sneezes. So, all right, I think I'm good right now, but just gave a warning in case it happens. Let's take a look at the pre-market report. These are stocks trading in pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. We got 352 stocks on our percentage gainers list, 54 on the decliners. From that perspective, we're looking like a more bullish bias at the open. Of course, the CPI number came out, and that was, widely watched number, giving us an indication what's going on in inflation. And based on that number, the anticipation is if the Federal Reserve will slow down or stop earlier at a peak rate. And today came out a little bit below the forecasted number. So now the market is, rallying stocks in the morning to celebrate that the inflation is still high, but it's slowing down and, going down in the right direction. But I think it's still pretty high. What was it? I was looking over my shoulder. I think it was like 7.1% of the CPI versus expected 7.3. And I think the core CPI was 6%, something like that. But still, you could tell it's pretty high. Fed's target is 2%. And we have a long way to go. Tomorrow, Fed meets, and it is expected that they will raise interest rates by 0.5%. And I think that's still going to be pretty much on the table. That's what they indicated. And I don't think today's numbers will change that, even though they're slightly better. Let's take a look.
Rob asks an interesting question. He says it will be interesting to see if the Fed decides to just keep rates around 5% for a decade or more, like the 50s, 1950s through the 60s. He said,
and I do think it's a risk that's not being priced into the market for sure. Doesn't seem that way to me. That right now, if you look at the how the yield curve slopes after 2 years, it starts coming back down. The 10-year, I think, is like right now 0.75% below the 2-year. And if you believe that forecast, then the market is saying that we're going to go up, and then we're going to come back down, either because inflation's going to come back down, and then the Fed will be able to bring down those interest rates, or we're going to go perhaps into a recession. The recession will force inflation down, and then they're going to have to stimulate, the economy. But that's what right now the yields are pricing in. And of course, I think there is a risk that we might go, 5% and have to stay there for a while, or, even if we come down, maybe it's going to be down, but not drastically, not below 4%, so I think that is a risk, to the market.
Yeah, and is it really that risky? I mean, it's risky. It's risky, I guess, to the market where it's being priced. But I mean, it doesn't seem like 5%.
Doesn't seem like 5% or 4% is like that high that we might not be there.
No, we went through an incredible period of free money, and it's changing, right? It's free. It was a combination, right? A free money. We had explosive productivity, because of technology driven, the internet, those were all deflationary pressures. China was a deflationary pressure, globalization, deflationary pressure. So a lot of stuff that was good as far as, productivity and keeping inflation low. And, I don't know, if that's going to continue, or we might see reverse of some of those benefits, especially like the globalization. We're seeing a little bit of the reverse of that. So it's not clear right now that we're going to head back to the same situation we were in, that was creating an environment where we could afford to make mistakes and have interest rates really low. Even at a full employment, we're able to keep interest rates pretty low. And right now, that's not the case. So we'll see. But yeah, 4 or 5% seems like not that unreasonable. It's not that high.
right?
Not in the history of interest rates, for sure.
Not in the history of interest rates. So let's filter this list to only S&P 500 companies. We want to take out ETFs, leverage products, closed-end funds, preferreds. Let's take those out, see what's going on in S&P. Obviously today it is already, we know it's up in the pre-market, but we'll just take a look at what stocks are hitting the top of the list. And here we have 97 stocks on a percentage gainers list, 200 decliners so far. And this does confirm that we're setting up for more bullish bias at the open. Let me see if we don't have any questions. Well, what I may do is go to SPY and look at some option strategies.
All right.
Benchmarks. And I think what we did was we talked about these strategy benchmarks. And really it's what we're doing is trying to track a certain strategy using options, multi-leg options, and how that strategy is priced relative to history. And the concept is very similar to the VIX. So the VIX, what is it doing? We're going to the options, and what we're doing is observing where the implied volatility is in the options, and then we calculate what a theoretical or hypothetical 30-day option is that's at the money. And the reason we have to do that hypothetical or calculation is because we don't see every day an option listed in every stock that's exactly 30 days to maturity, and that we could find a strike that's exactly at the money. We can't do that, right? Options don't get listed that way. They'll list a weekly, and then when the weekly expires, they list a new weekly, or they'll list a regular monthly option, but they won't list a new one until that one expires or close to expiring, and then they'll list a new one. But we don't have one that's exactly 30 days to expiration every single day. All right. And we don't have a strike that's always at the money, right? So the stock moves away from a strike as it's moving to a different strike. It could be in between strikes, so it's not always at the money. And but because all that is happening, you really can't create you can't just have a benchmark from here. We'll go to the options chain for now. You can't just create a benchmark by observing a particular option. All right. So here I have an option, 400 strike. It was at the money. Here, stock closed at 390, right? Or where was it? I'm sorry, 399, let's say 399. So of course this was at the money yesterday, but it's not going to be at the money any longer, right? When the market opens, that's going to be in the money. So there's going to be a new at the money strike somewhere up here if we are near 410. So this one will be the new at the money strike, right? So I can't just follow a single option going to create a benchmark because it's a derivative and the strike price relative to the spot price is changing. The other thing is, the days to expiration are changing. So even if I follow this option expiration, you could see that yesterday it had 7 days to go. Now this same option has 6 days to go. Then it has 5 days to go, 4 days to go, and eventually it expires and it's gone. So there's no way to just pick a single option on the board and follow it and say, that's my benchmark. That's my at the money benchmark. Can't do that. The alternative is then we have to create a hypothetical option that's at the money with always 30 days to go, right? And that we do by a formula, same formula as VIX, but you'll find two expirations that straddle 30 days, just, that straddle 30 days. Let's say one's more than 30 days, one's less than 30 days. So here's one that's 31 days. And you give those expirations weighting based on how far away it is from 30 days. And then every day you roll it. So this way you have a formula, which is a benchmark trying to say that here's a hypothetical 30-day option. And then we take a weighted average of the strikes around the at the money and create a hypothetical at the money option, right? So we have this hypothetical 30-day constant maturity option that's at the money. Okay, it's kind of like a 10-year bond, right? There's no exactly 10-year bond every single day. There's a formula to say this would be the 10-year yield. And this is how pretty much you get the at the money for the VIX, right? The VIX has a different formula. They take in other considerations and have methodology for strikes that are deep out of the money and strikes that don't have a bid, or or go wide. So you got to read the methodology. But that's how we track it. And by having that benchmark, then we could see if it's relatively high or relatively low versus history, right? So we could benchmark it and then compare it. What was it a week ago? What was it a year ago? What was the average for the year? How many observations were below the current level? How many observations were above the current level in the last year and the last 2 years, and so on? Okay, that's the benefit of creating a benchmark. But keep in mind, a benchmark, right? It's a calculation. It's not something that you could, it's not a tradable thing. It's just a benchmark to let you know how high or low it is relative to history. Okay, and you could compare cross assets. But when we take an implied volatility like the IV30, it doesn't really price if you're interested in a certain strategy in SPY, right? So I can't really tell you, well, how does a call spread line up, or how does a butterfly line up, or how does a calendar spread line up relative to history, because the VIX isn't going to tell me that. The IV is not going to tell me. The IV, like we just said, it's looking at a specific calculation benchmark, and it does not take into account a multi-leg strategy, right? It just tells you where the implied volatility is for 30-day constant maturity at the money option, right? That's it. That means we have to create different benchmarks for strategies. And those will be different because multi-leg strategies a lot of times are based on skew, right? And based on buying and selling an option. You're not just getting long something or just getting short something, but you're doing multiple things. So for example, a butterfly, what's a butterfly? You're doing at the monies, let's say, so you could see here, I'm setting up a butterfly here. I sell at the money call, at the money put. But look what happens when I go out. Let's say we start at 399 and let's go to 390, right? So I'm buying the 390 put. But look what happens between the 399 strike, the implied volatility is 22, and the 390 put, the implied volatility is 23.6. So there's a difference, right? 22.4, 23.6, and I am selling one and I am buying one, right? And that is a skew because there's a relationship between an option that is, at the money and an option that is, let's say 2% out of the money, right? That is a skew. There's a relationship. And the question is, if we're benchmarking it, is that skew high or low, right? Let's go now to the next one. So that's the put we bought. Now we got to go up to the call. So I don't have what do I need? 10. So 499. Let's do 408. So look at the 408 call. Now I'm buying this. That implied volatility is 21.8, and I sold 22.9. So keep in mind, I'm buying and selling an option, right? It's not just getting short Vega or getting long Vega. I'm buying an option and selling an option, and my Vega position will really change based on where the stock is going to move to. All right. When the stock moves to my long strikes, I'm going to be longer Vega. If it moves to my short strikes, I'm going to be shorter Vega. But here, there's another relationship. If I'm selling this and I'm buying this, right? I'm spreading them out. Well, there's one volatility like skew, and there's a relationship between them that this butterfly, think of it as a butterfly, it's flapping wings, that it's going to flap around, right? It's going to go from high to low, high to low. So just like in the IV rank, well, a strategy will do something similar, but there's a relationship, right, as they're moving, right? So one isn't going to just continuously move up without the other one. There's a relationship between them, and that's what we wanted to measure. And that's why we start creating benchmarks for strategies. So here's a butterfly, right? That's what it looks like. And we see that we get a 790 credit if we hit the bid here. And we could go to the IV Theo to see, well, where's this benchmark historically, right? So here, this is telling us really quickly, last 4 years, if we did a similar spread with the strikes same distance away from each other, stock with same days left to expiration, this was the average value, and you could see the range here, right? But that's because I entered in. So that's this tool, right? This tool is powerful enough to actually go back and find you a similar situation. Doesn't matter which strikes you pick, doesn't matter days to expiration. It's going to go back in time and set it up for you. But when we do that, it's hard to get a quick glimpse. What do we think the strategy is, high or low, right? That's why we have the VIX, right? That's why we have the VIX to kind of just give us an idea, where the options kind of lining up. So without having to set up the strategy in the options chain and running the analytic like I just did, that's why we have these strategy benchmarks. And what they will do is allow us to look. Let me see if I have a butterfly actually on here. Let me see if I did a butterfly strategy. I have another iron butterfly. So this is a little bit different. Oh yeah, here it is, iron butterfly, right? So 30 days selling at the money, right? And buying 5% out of the money wings, right? Buying the call 5% out of the money, selling the call 5% of the money. We could see here gives you a credit of 3.5% versus historically 3.4. So yesterday, remember, this was yesterday's close. We're not open yet. That butterfly was slightly higher than its average, right? On the day was unchanged, but slightly higher than its average. And this is how that benchmark moved around, right? So when you get more credit, right, that means for selling it, you're bringing in more. And if it's above the average, you're getting more credit above the average. If it's less, that means you're bringing in less, and if you're buying it, then you're paying less for it. So that's really quickly I wanted to go over strategy benchmark. And I don't have time, but I was going to set up a different strategy for you guys, but I think we're running out of time and we do have that webinar today. So I'm going to leave it there.
Yeah, and we can follow up tomorrow on what you wanted to go through for the next strategy as
Yep.
well. All right, awesome job, D. I will put again in the chat our link to our webinar today at 2 p.m. You must register if you want to come to it. It is run by Interactive Brokers, and even if you can't come, if you register, they will email you back with a, either the video or a link to the website to watch the videos. They're all stored in the IBKR library. Great job, D.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day. Hope to see, some of you today at 2.